Time is supposed to be neutral. It passes for everyone, 1 second at a time. No shortcuts, no exceptions. But in modern finance, time is anything but neutral. It's bent, compressed, stretched, and quietly turned into a weapon. Not with force, with math. Right now, entire financial empires are built on one simple idea: who gets paid first and who gets paid later. And the difference between those two things is everything. This matters now because we're living in a world obsessed with the future. Future earnings, future growth, future promises. Trillions of dollars are priced not on what exists today, but on what might exist years from now. And the further you push profits into the future, the stranger the system starts to behave. To understand why, we need to rewind to a deceptively boring concept: interest. Interest looks harmless. You lend money, time passes, you get more back. But interest does something subtle. It turns time into a multiplier. $1 today isn't equal to $1 tomorrow. $1 today is worth more. Not because it's better money, but because it has time to work. Now, flip that idea around. If money today is more powerful than money later, then anyone who controls early access controls the game. This is where finance quietly stops being about productivity and starts being about positioning. Let's start with discounting. Every financial model uses it, even if nobody talks about it. Discounting says future cash is worth less than present cash. The further out it is, the less it matters. $10 today might be worth $12 next year. But $10 promised 10 years from now might be treated as worth $6. That single assumption shapes everything. It decides which projects get funded, which companies survive, which problems are considered urgent. Long-term payoffs get punished, short-term returns get rewarded. And suddenly, patience becomes expensive. Take corporate behavior. A company can invest in infrastructure that pays off slowly over decades, or it can boost quarterly earnings right now. Markets say they value the future, but pricing says otherwise, because the future is discounted. So executives optimize for the present. Buybacks beat research. Cost cuts beat resilience. Not because leaders are evil, because the math quietly pushes them there. Time weaponized. Now zoom out. Debt doesn't just move money across people. It moves money across time. Borrowing pulls future income into the present. Repayment pushes cost forward. Sounds fair, until you realize who gets to borrow cheaply and who doesn't. Governments borrow at low rates. Corporations borrow cheaply. Asset owners borrow against things that already exist. Everyone else borrows at higher cost or not at all. Which means the future income of some groups is discounted more harshly than others. Same time, different price. That gap compounds. And compounding is where time turns brutal. Compound interest is often called magical. Einstein gets quoted. Everyone nods. But compounding isn't magic. It's asymmetric. It rewards who start early and punishes who arrive late. If you have capital now, time works for you. If you need capital now, time works against you. Interest accumulates quietly, relentlessly, with no memory of fairness. Miss a payment and time accelerates the penalty. Make consistent returns and time amplifies the reward. Same clock, opposite outcomes. And this asymmetry leaks into everything: housing, education, healthcare. Take housing. Buy early, even at high prices, and time helps you. Prices rise. Debt shrinks in real terms. Equity builds. Wait too long and time turns hostile. Prices move faster than wages. Rates rise. Access disappears. It looks like a market problem. It's a timing problem. Now, layer in financial markets. Modern markets don't just trade assets. They trade expectations of time. Stocks are priced on future cash flows. Bonds are priced on time and trust. Derivatives slice time into fragments and sell them separately. Risk isn't eliminated, it's rescheduled. Losses get delayed. Gains get pulled forward. This creates a strange illusion of stability. As long as nothing breaks today, everything looks fine. Crises don't arrive suddenly, they're stored. Hidden in refinancing, rolled over in debt, deferred through accounting tricks. Time absorbs the shock. Until it doesn't. Then the bill arrives all at once. This is why financial crises feel abrupt, but they're not surprises. They're delayed consequences finally catching up to the present. Time snapping back. Now, let's talk about inflation. Inflation is often described as a failure of discipline. Too much money, too much spending. But inflation also redistributes across time. It quietly reduces the real value of future obligations. Debts shrink, savings erode. Inflation favors borrowers over lenders, present spenders over future savers. It's not random. It's a time shift. Which is why inflation feels unfair. Because it doesn't hit everyone equally or at the same moment. Some people adjust prices quickly, others wait. Wages lag, assets jump. Time again decides winners and losers. And here's the uncomfortable part. Modern finance doesn't just respond to time. It creates time pressure. Deadlines, maturity dates, quarterly reporting. Artificial urgency forces behavior. You don't need to threaten anyone. Just set the clock. Miss the deadline, lose access. Miss the payment, lose the asset. Miss the quarter, lose investor trust. Time becomes enforcement. Silent, impersonal, effective. This is why the system feels exhausting. Not because it's complicated, but because it never stops counting. Every second adds interest. Every delay increases cost. Every pause is penalized. And yet those with enough leverage can slow time down. They refinance. They restructure. They extend. Time bends around power. So when people say finance is about money, that's only half true. Finance is about controlling when things happen. Who rates? Who doesn't? Who absorbs delay? Who escapes it? Which brings us to the question nobody likes to ask. If time can be priced, if the future can be discounted, if delay can be weaponized, then what happens to problems that only pay off decades from now? Climate, infrastructure, demographics. What happens in a system that systematically undervalues the long term? And if time is the most powerful force in finance, who exactly is holding the clock?